Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, they would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 135. As always, joined by the three amigos, Rich Diaz, PGM Global, Keith Dicker, IceCap Asset Management. What's going on, Boomer?
Boomer is very patiently waiting for summer to remotely come close to the Maritimes. It's still cold out here, boys. Still
got
cold.
the thick Patagonia jacket on there.
Yeah. I'm waiting for my Patagonia Speedos for the summer, but we're not quite there yet.
We should get some Loonie Hour Speedos on the website there, Rich.
We're working on it.
Boys, we could wear those a model and when we go to Rich's camp later on this summer. That would be quite the t-shirt, wouldn't it?
It would be. Ugh.
Rich is working out like twice a day for his all his Tinder dates.
That's right.
Rich, hey, you got the Manscaped shirt on too. There you go.
Free plug. They gave us swag. I got to rep it. They also gave us some underwear, but I thought that might not be appropriate for the Loonie Hour.
They haven't advertised since you botched that ad read 4 weeks ago.
I'm sorry. Well, I'm wearing the t-shirt now, so there you go.
They pulled the ripcord.
Give him some business, some love from the Loonie Hour. But no, otherwise it's good. It's been a horrible spring so far. It's been lots of rain. But yeah, I'm ready to go up north too. So let's kick it off. I think we have an interesting day today.
Yeah, we've got an important guest here. I'm just traveling today, so I might duck off a bit early on this, but I know you guys will kind of run with it if need be. But to fill in my shoes, we do have a really awesome guest this week. I've been really looking forward to this one, so I was like, I can't miss this podcast. We've got Grant Williams coming on the show today. For those of you who aren't familiar, he's logged over 35 years in finance. He began his career in the Japanese equity markets in the mid-1980s. And currently he's a senior advisor to Matterhorn Asset Management in Switzerland and a portfolio and strategy advisor to Volpes Investment Management in Singapore. He was also the co-founder of Real Vision, and he currently runs the Grant Williams podcast, which is, other than the Loonie Hour, is my favorite podcast. I personally subscribe to it. And he runs a newsletter called Things That Make You Go, And so Grant is widely considered a thought leader in the industry. He's a regular speaker at any major event. And like I said, I can't recommend his podcast enough. So I think you'll really enjoy this thought-provoking conversation here today. What are you thinking, Boomer?
He's looking at something.
Yeah, I'm trying to figure out some of the controls here. This is gonna be a fun conversation. I first met Grant maybe 12 years ago. So I started writing a newsletter when I launched IceCap, and I was having lots of success with it. And then one day, one of my clients emailed me and he said, "Hey, Grant Williams just used a piece of your letter, your newsletter in his letter." And of course, I responded, "Grant who?" But he's a super nice guy, and he has some great friends, and his network is very deep around the world. So he's going to give us a pretty good view on what's happening in Canada, why people might be interested in Canada at this point, or how everything is synchronized here together. So it's going to be a great call.
Hey, did he source your work, or did he totally rip you off?
He totally sourced it. Yeah, absolutely. Yeah. If you're a
I
nice
think
guy in anything
you're
you
just
do.
saying that because he's about to join us. Should we ask him?
Yeah, we could ask him. He'll say, "Oh, I don't remember doing that." Maybe
Hey,
not.
so people always ask Keith, how we met and how we started this podcast, and so Keith and I, you and I originally met on Real Vision, which was the Real Vision team, which again was co-founded by Grant, reached out to us and said, "Hey, you guys are two Canadian voices. You guys want to do an interview on Real Vision about what's happening in Canada and the real estate and the financial markets." And so, we did that interview, and it was well received, and they got us back on for another one. I think a year later, and we figured, hey, why not make a run at this and do our own show? So, Grant might be.
What am I, chopped liver?
Well, Rich was just this shoe in that, thank God we had
But
you.
it's a good story, in terms of how like our world works. Same as anyone else's show. You meet a person and then somebody else, and you go like that. But the gentleman who helped you and I out first, Rich, was Jack Farley, and Jack has since moved on, and he's doing his own podcast now. And I
Forward
can't remember
guidance.
Yes, Forward Guidance.
That's a
Yeah.
good one. I like that one.
Yeah, I was chatting with Jack yesterday. I think I'll be on his show next week, I think, coming up. But again,
Wow, wow, big drop there, eh?
Yeah, kaboom.
Not a big
And
deal.
but yeah, I think that's what's so great though about the investment world today. Everyone can get connected. So we have Grant is here ready to come on. So let's just say hi to Grant.
Grant, welcome to Loonie Hour.
Hey fellas, good to see you. How's everybody doing?
Doing well. Thanks for coming on. First show on the Loonie Hour for you. We're honored
great
to have
pleasure.
you.
Thank you very much. Thanks for inviting me.
So
But Steve, we've had a lot of guests so far. I think we've had two guys have been on twice. So this makes Grant, you're tied for third for having the most
All right,
visits.
hey, I'll take it. I'll take it.
Yeah. So Grant, huge fan of your podcast, which I teed up before you came on to the show. Like I said, it's the second best podcast out there today. And one of the core themes of your podcast is the central bank endgame. It's with your co-host Bill Fleckenstein, and do you want to walk us through that sort of core idea that you have, big picture thinking, the central bank endgame? I think Keith and I and Rich here, we've kind of touched on it a little bit over the last year and a half, but what's your view on that?
Well, look, I think the interesting thing about it is that the fact that we have to talk about a central bank endgame at all, because there was a time, and it wasn't that long ago, certainly during my career, that central banks weren't the be all end all of every single asset price in the world. They were there as lender of last resort. They were there to provide support in moments of crisis, and they've injected themselves so deeply and so broadly into just about every part of the financial system that they are a big part of the conversation when you're trying to figure out just about anything. And so, Bill and I have kicked this backwards and forwards for a long, long time. How does this ultimately end? How do the central banks lose their perceived control of markets, of asset prices? What are the steps that lead to that, and how do we recognize when we start to reach that end game phase? Obviously, there's no way you can pin it to the day, but how do we recognize when we reach that phase where you need to pay attention because the chances of losing control are escalating? And I think Bill would agree with me, and many of our guests certainly have, that we're there now. We're in that phase where the control of asset prices and financial markets that central banks have had for many, many years now is not a given anymore. We've already seen inflation punch them in the nose. We've seen, the transitory narrative get flattened. We've seen promises of rate cuts get taken back. So it's clear they're no longer in complete control. And so if that's the case, and we've spent 20 years with central bank controlled markets that have just basically gone up, except for a few short but violent periods of downward action. What does that mean? And one would have to suggest that if the central banks are losing control, then the conditions that we've become used to, which is markets generally going up and low volatility, are probably going to change. And that is going to require a complete rethink by everybody involved in investing and speculating as to how they navigate that new environment. So really, that's what the podcast is all about, just thinking about ways in which this could come about, thinking about the different ways in which it will affect different central banks, and trying to understand what it means going forward.
I think, I think we'll all agree that the end game probably started back in 09 or 10, as soon as the central banks hit zero and negative in QE. And then the game has been, we've gone through full time. Now we're in extra time. And we're trying to figure out, hey, when is the game going to end, and how is it going to move? But you did say a key word though, Grant. When and how do the central banks lose control? I mean, I think most of us would agree they haven't lost control yet. I mean, we get a few moments where it does seem to be out of control from a broad market perspective. But it goes back to, like, is it the Americans? Is it the Fed are the ones that everyone's always watching? They're the ones that have the most control or the most responsibility for trying to keep the world in control?
Yeah, well, I mean, look, they're certainly the most influential, Keith. I think we can all agree on that. And their policy decisions most definitely shape the policy decisions of other central banks. But control's a funny thing, right? Very famously, Margaret Thatcher had this great quote. She said about being powerful, but I think control fits this quite nicely. She said, being powerful is like being a lady. If you have to tell people you are, you aren't. And I think control comes under the same kind of thing, right? Control is an interesting thing. If you have to tell people you've got it, you probably don't. And so we've all gotten used to markets doing certain things in response to predictable actions by central banks. And that's changed. It has changed. And so does it mean they've lost control? No. Does it mean they're losing control? I would argue yes. I think there are signs there that they're not having everything the way they want it. And that's a meaningful shift, because everything has been predicated upon believing that central banks have got this under control, believing forward guidance, and really being bullied into doing what the Fed wants everybody to do. We want people to take more risks, and so we are going to create conditions that force them to take more risk. And of course, everybody did. And now that's not quite as concrete as it was for quite some time. So that's really, I think, the point that we're making is that before COVID, there was very little to be gained in taking the other side of what central banks were saying. Post-COVID, you will have been able to make some serious money if you'd been taking the other side of projections from the central banks about interest rate moves. And that's a very different environment. And so people need to think differently.
Would one of those key indicators be, the Bank of Japan, in terms of losing control, or at least it seems like they're starting to lose control? A central bank that has basically monetized all the debts over the last 20 years.
Well, the Bank of Japan has long been everybody's canary in the coal mine, and with very good reason. I think the parallels that people draw between Japan and other central banks, we're all Japan now. I think they're a bit too simplistic because Japan is a very different culture to other parts of the world, very different market setup, very different holders of their government debt, the profile of the holders of their government debt to other central banks. So it's not quite apples for apples. But because they've been so far ahead with this negative interest rate experiment, zero interest rate experiment, because they're so far ahead in terms of the size of the purchases of JGBs that the central bank has made, and of course the ETFs they've purchased, and the size of their debt to GDP, everybody's been looking at Japan and figuring, well, if we see what Japan does, we'll get a warning, and we can apply that knowledge to other central banks, and we can apply that timing to other central banks. And I just think that's a bit too simplistic. And what's happening with the Bank of Japan now is really, really interesting. You know, they've reached this point where they realize they need to try and get rates up again after, you know, almost 2 decades of zero interest rates at best, negative interest rates for long periods of that. And that's a huge change for the world. You know, right now we're seeing a lot of weakness in the yen, which was predictable. You know, we've talked about this on the podcast. I've talked about it myself that the yen could easily get to 160, but you know, I can see a chance that it could get much stronger than that quite quickly and catch a lot of people flat-footed, particularly if other central banks decide that a coordinated intervention is in more people's best interest, which if you look around Asia, it certainly is. So Japan is still a canary in a coal mine, but I think it's a slightly different canary in a coal mine now. It's not a case of, okay, as goes Japan, so goes the rest of us. It's now become what happens when you are threatened with a currency crisis because of all the policy decisions you've made, and the only escape valve you leave because of the size of your balance sheet and the fact that you're drowning in government debt is the currency. What happens next? And we've got a front row seat to that. And you know, it could go either way, but it's going to be important. It's going to be profound, and because of the nature of the yen carry trade and the nature of the sheer amount of capital that Japan sends overseas, it will have a significant impact on liquidity and capital flows. So we need to pay attention and see what happens.
I think, we bantered around the whole Japanese story there last week. And one thing I love now about Japan is that, people are starting to talk about it again. Because it's always been, don't worry about Japan. They're a unique case, one-off case and all that. And all of a sudden, four nerds are getting together on a podcast and we're talking about it. But, back to this whole central bank narrative. And this is the one that I keep coming back to all the time, Grant, is that one area they've had success with, and their success with what I'm about to explain is actually a complete failure, is that they've had success in really suppressing the business cycle or pausing the business cycle. And that there's so many people now in the Western world, we've never really experienced a recession. The COVID downturn is something completely different, of course, but a normal economic downturn hasn't happened. And up here in Canada, my God, if we get a recession, I like to say that, it's going to rip the soul out of Bay Street, just, it'll come right out. Did you hear that, Rich? The noise? No, normally they don't hear the sound effects on our podcast. But maybe talk a little bit from what you're hearing in your conversations about what a recession may look like coming up, and try to relate it back to Canada if you have any thoughts on our market, because it sort of does relate to the safety with Japan. Japan looks to be screwed, but they've been showing that look now for a couple of decades, especially. But maybe just share with everyone, hey, this is how it might look, how the end game might turn from that perspective.
Yeah, I think the big difference with Japan is that the debt levels in Japan are on the government balance sheets. They're not on the corporate balance sheet. They're not on the personal balance sheets. And that's a very different situation to Canada, obviously, and other countries like Australia, right? A very similar situation. And so when a recession comes, and it will, I mean, it may not come imminently, but it may. It's a lot more imminent now than it was a year ago, that's for certain. When it comes, we are going to see a whole lot of people who have been forced to borrow way more money than they can afford to pay back, simply in Canada and Australia, particularly through house prices alone, to forget the cost of living, which is going through the roof. So people have not only been forced to borrow, but they've become very used to borrowing, and also painfully and problematically very comfortable with having a lot of debt. Having a lot of debt is not something that people worry about now. They've just grown into that, of that debt's the way you do these things. You just borrow money for stuff because you've been able to. And it really is at these inflection points, it's the change in mindset that gets people and throws people for a loop. And the longer you go without a recession, the more people come into the workplace, the more people build that immunity to debt and that lack of fear about debt. And the more they have their their fears assuaged by central banks cutting rates and cutting rates and cutting rates every time there's a problem, and that debt never comes back to bite them, the more comfortable they get holding the debt. And so there's going to be a reckoning, when the recession hits and people start losing their jobs, that's when they can't afford to pay these credit card bills. They can't afford to pay these mortgages. And I fully expect to see all kinds of talk about relief from the Canadian government, from the Australian government. We're seeing it in the US now with student loan relief being proposed and housing debt relief being proposed. It'll be credit card relief being proposed. And of course, these are lunatic policies, the way they're being couched. But they're
Actually, Grant, in Canada, we refer to them as being a wacky policy.
There you go. Okay, yeah, fair enough.
Not a lunatic.
Yeah, that's fair enough. But we can see where all this is going, and the debt, whether it is at the national level or at the corporate level or at the household level, it's ubiquitous. And Japan's in, weirdly, a much better situation than most of these Western nations, but Canada and Australia particularly, because of the way the housing markets have behaved in those countries, and because maintaining those high property prices in both places, and we'll throw New Zealand in the mix as well, has become almost a matter of national security at this point. I mean, if there was to be a housing crash in Canada, New Zealand, or Australia, it would be absolutely devastating. And so, Australia, I'm more familiar with Australia than Canada, but I believe the policies are very similar in terms of we are going to stealthily keep immigration extremely high, because the immigration is where we're going to manage to put the bid under the houses, because we're going to get a lot of wealthy nationals from overseas coming in, whether it be to college or whatever it is, and propping the housing market up. And it's a shame, because, what all this stuff means in terms of these high-priced housing particularly, but also the RIAs, the 401ks in the US, the ISAs in the UK, all these stock-specific, bond-specific pension saving schemes that are out there. The one thing that's going to happen one way or another is a massive transfer of wealth. It's going to have to come, and it's not necessarily this time going to be from the civilians to the government. It's going to be from old civilians to young civilians, and it's going to be from rich civilians to poor civilians. Those two transfers are going to have to take place, because society doesn't function long term the way it's currently set up. And so how do those transfers take place? Do they take place through taxes? Do they take place through massive drops in asset prices so that the young can afford to buy houses at half price from people who are over their skis or leveraged? Does it happen through taxation? Does it happen violently? We don't know. But the way that Western economies and Western societies are now set up doesn't work. And so those things are going to happen some way or another. And hopefully we can find a way through dialogue to make them happen in a peaceful, equitable way. But the haves and the boomers and the kind of bleeding edge Gen Xers are going to have to get comfortable with the idea of, we're not going to have a tailwind our whole lives. There's a period coming where we're going to have to voluntarily give some stuff back. And I think a lot of people are okay with that. But how do you orchestrate it on a broad level is going to be one of the crucial things for politicians to try and understand.
Yeah. So Grant, how do you see that playing out? We have all these levels of government here in Canada today coming out and talking about, housing affordability, we're going to build so much housing supply, but of course, nobody ever says, in terms of making housing more affordable, you really need a decline in home prices, which nobody actively campaigns on. And so I agree with you, in the fact that what I see, at least in my day-to-day business, I mean, I never see any first-time home buyers getting into the housing market here in Vancouver, and I'm sure you can lump Toronto into that, on their own. It's all a wealth transfer from their parents. Their parents bought their house for $200,000. It's now worth $2.2 million. So they stroke a check for $300,000, and there's the down payment for their kid to get onto the housing ladder. And if your parents weren't fortunate enough to ride that housing lottery 30 years ago, you're at an extreme disadvantage.
Yeah.
And so I do wonder what the societal implications are for that and how you kind of see that playing out. I mean, you can imagine the pitchforks that may be coming in this current system but it seems like they don't have any other option but to try to maintain it somehow, some way.
Yeah, and look, this comes back to what we were talking about with the central banks at the top of the show, in this idea of control and wanting, and more importantly and more dangerously, being used to having control and expecting markets to bend to your will and expecting policy X to have outcome Y. And the same way that the public have become used to, market falls, central bank cuts rates, market stops falling, markets go up, houses go up, everything's great. Everyone's gotten used to that set of circumstances playing out. And by the same token, the central bankers have gotten used to we cut rates, markets stop falling and start rallying. Politicians have gotten used to borrowing costs stay low, we can borrow forever. Everybody's got used to this status quo, which is an incredibly dangerous status quo. And of course, it feels great while you're in it and everyone can borrow money for nothing. Then reality bites and it's a problem. So, how it plays out, Steve, is the 64,000 or probably $64 trillion question these days because of inflation. But that's the thing that everybody needs to be prepared for. And by being prepared for it, what I mean is that it has to happen. And so all you can really do at the moment is at least take the time to entertain the kind of outcomes that you've had no reason to even think were possible for the last 25 years. Are we going to get wealth taxes? Are we going to get one-off taxes on $10 million plus real estate? Are we going to get capital controls? Are we going to get forced buying of government debt by pension funds? 10 years ago, the answer unequivocally to all of those questions was no. Today, if you answer all of those questions unequivocally no, then I don't think you're devoting the right kind of time to thinking through the problems that all these people face and the solutions that they have at their disposal, because those solutions are few and far between, and many of them come back to those kinds of things, those kinds of policies that I've just laid out for you.
Yeah.
So can I just jump in there? Oh, sorry.
Yeah.
Sorry, quickly, just on that point. About 2 weeks ago, the federal government here in Canada announced they're increasing the capital gains inclusion rate. So basically, an increase to the capital gains rate to basically anyone that is earning capital through a corporation, and then if you're an individual, is $250,000. So, anyways, long story short, is they branded this as fairness. They said fairness for every generation. So we need to come after the people that have accumulated too much money. And so, yeah, to your point, I think you're spot on. It's a slippery slope in terms of where we're going.
And of course, it is couched in those terms always, right? We're going to be fair, and people have to do their fair share. And you can argue this any way you want. And the wealthy will argue that we pay way more taxes than the poor. And this is where you get into this back and forth. It doesn't really work. And I've talked about this a lot, but years ago in my Real Vision days, I interviewed Jeff Gundlach, one of the brightest guys in financial markets anywhere in the world. And he said something to me that stuck with me ever since. And I go back to it time and time and time again. And, we were talking about fear and greed. And Jeff said to me, he said, fear and greed are very powerful. He said, but there's something that's more powerful than both, and that's need. He said, if you need to do something, you don't have a choice. And if you think about the situation that governments are in, particularly governments, central banks are in a bit of a bind, but governments, technically speaking, don't have the ability to print money and spend it, right? The central banks have that ability, but the governments don't. They have a budget, which is going to be balanced or in deficit or in surplus, God forbid. But they have needs. They have a need to get elected again. And that need drives their decision making. And we're seeing this with the Biden administration and some of the things that they're doing because they realize they need votes. And so what do we do when we need to get the votes of the young? Well, we start paying off student loan debt because that's a great vote winner. And we do this and we do that. So we're in the need phase of this now. And in many ways, that's problematic because it brings in these kind of policies that were absolutely off the table for many, many years. But to the investor or the speculator who is willing and able to think through the ramifications of what these needs mean, it actually can be quite helpful, because if you understand that they need to raise more money because they're all broke, and they need to plug these deficits. Once you get that into your head that it's a need, then suddenly you realize, okay, if they need to do it, what are they going to be forced to do? That might not seem like a smart policy, but they might be forced to put capital controls in place. They might be forced to mandate pension funds hold 20% of their assets in government debt. We don't know. But suddenly, through that need prism, you realize that, okay, if they have to do this, they'll find a way to spin it. To your point, Steve, all right, we'll call this fair. We'll call this, a voluntary tax on the super rich, or there are all kinds of ways to spin these things, and they will do that. But they're all in the same boat. They're all flat broke. They've all borrowed way more money than they should because they've been enabled by their central banks. COVID's come along and screwed up everybody's finances, and here we are. So we're in the need period, which is a part of the end game, and so everybody listening to this needs to think this through about what do they need to do, not what do they want to do, or not what they should do. God forbid that ship sailed a long time ago. But what do they need to do?
So Grant, if I can jump in there. So you talked about central bank control. To what degree do you think the massive deficit spending in the US and elsewhere has dislodged that sort of one-to-one or whatever mechanism between central bank policy and the market? Is that part of the reason that they've sort of lost control? Because deficits and deficit spending is no longer perceived as bad or ill, and the bond market can appreciate it?
I don't know that that's true, Richard. I don't know that it's no longer considered a bad thing. I think the key shift here is that because of what central banks have done and because of the environment they've created and this illusion of control, the big shift in my mind, and we can argue and go backwards and forwards this all day long. I'm very curious to hear your thoughts, but the shift in my mind has been that the deficit spending is absolutely a bad thing. Having a 6-7% deficit at full employment is ludicrous. It's ludicrous.
Agreed, by the way.
But yeah, right. But the big shift is people are saying it doesn't matter for now. They're not saying it's not a bad thing. They're saying it doesn't matter. And that's a very, very different thing, because in financial markets, things that don't matter tend to not matter to anybody, and then one day they matter to everybody.
Yeah.
because financial and economic gravity reasserts itself, and people suddenly look at Tesla on 60 times or 120 times earnings and say, well, no, that doesn't work anymore. It's not a growth company. And financial gravity has a habit of reasserting itself. We're not in that phase at a national level yet, because people still believe that there are some big bullets left in the fiscal and monetary bazookas. But I think people are going to find that, given the global nature of capital flows and the global need for these central banks to fund themselves and crowd out private capital, we are going to see private capital demand higher interest rates if people want their pound of flesh, or want their money invested. And of course, the solution to that, once again, is to monetize the debt, right? And that's probably what we'll see next. When the markets start demanding higher rates, well, guess what? The Fed's going to step in, the Bank of Canada is going to step in, the Bank of Japan, the Bank of England, the ECB, they're all going to step in again and start buying the debt to keep rates down. And then you get to the point where every currency starts to look like the yen, because none of these currencies are going to hold their purchasing power once this stuff starts to happen. And that's to me, that's what gold's sniffing out. And I think gold is also sniffing out this huge geopolitical shift about the sanctity of sovereign assets, and the fact that we've seen that they can be confiscated arbitrarily by a capricious central bank against all kind of international law and precedent. So there's an awful lot going on here that is kind of swirling around in different parts of the kind of tide pool. There's all these little eddies in different corners, but each one of them is important for people to understand, I think.
So let me just jump in one more. It's just, so there's also there's financial gravity, but I think there's demographic gravity.
Absolutely.
And political gravity related directly to those demographics. And yes, the baby boomers are rich and powerful now, but they're in the 8th or 9th inning. They're in the 2nd inning for an Aussie or a Brit, and they're going to die soon. And so, yes, they're rich, and yes, they have lots of assets, but the inevitability of the human condition is eventually you expire. And there's a political sort of wave coming through there. And you say what will need to happen is like the vote buying that has gone on for the last 20 years has been of the seniors, of the baby boomers.
Yeah.
And we're seeing that that's coming to shift. And so, you know, when we talk about like, and also there's like a market gravity that I genuinely believe in. And we've talked about on the show, which is you've got the supply of labor is well below the demand for services by old people. And those people are rich, and there's numerous, not many of them. So isn't there a way for a market clearing or a wealth transfer mechanism to be through higher wages and just structurally higher inflation as a result?
Look, I mean, that's ultimately, that's the battle they're trying to fight, right? Because they're trying to fight structurally higher inflation, because with the debt the way it is, it's not really what people want, a higher inflation, which begets higher interest rates, which begets all kinds of defaults, right? So that's the one hand that's constricting. And that's, inflation has been the missing link for such a long time now. They've managed to continue these policies because inflation didn't show up. That was the only thing that was ever going to keep them honest and hold their feet to the fire. And it's here now, and it's here in spades. Once you start embedding wage price hikes in the system, you can't lower those again, right? People, if they want to lower their wage bill, they're forced to lay people off. You can't say, oh, we're going to give everybody, you know, we know that 10% pay hike that we gave you last year that you fought us tooth and nail for, well, we're going to cut it 10% this year. No, we're going to go back to the 70s and industrial action and all kinds of stuff. But your demographic point is a really important one, Richard. And I think that the answer to that particular piece of the puzzle, you hinted at, and that is that the lawmakers are all boomers still. And in dribs and drabs, they're showing signs of retiring or falling off the perch here and there, but they're not giving up en masse. They're not, you know, retiring to spend more time with their family like all good policymakers do when the end comes, right? It's not happening.
Grant, isn't the average age of the age of the average senator in the America 98, 96?
I mean, it feels like
it's a pretty old guy. Yeah, there's some pretty old guys
it really
down
is.
there.
But we haven't seen this wave of millennials. You know, the Gen Xers are going to get looked over once again. I'm a Gen Xer. We always get looked over. So we won't have our
sound like sour grapes that sound like
oh yeah,
sister.
hell yeah.
My sister cries about that too.
There you go. Yeah. But we're quite happy just being left to our own devices. Just ignore us. Let's get on with it. It's fine. But until we see a wave of millennial politicians take office who are, by definition, looking out to protect the interests of their cohort, right? It's going to be very difficult to see boomers make policies that are anti-boomer. It just because it's them, right? And their constituents and the people that elected them, they know who they are. They're people with grey hair and 3 holiday homes like me, and that's whose interest I'm looking at. That's who sent me to Congress to look out for them. So I think we're probably not going to see that this election cycle, but next election cycle, because I think things are going to get worse, not better. So the next midterms, you know, whether it be left or right, I don't know, but I suspect you're going to see a much bigger swing from old to young in terms of incumbent politicians with hair the color of mine getting booted, and younger politicians coming in, and that creates a very, very different set of problems nonetheless, because what they're going to inherit is an almost impossible situation to extricate themselves from. But the policies they will likely choose to deal with that situation will be very different to the policies being used today. And that, I'm not saying that's a bad thing, but it's going to be destructive to wealth in many, many ways, and it's going to be confiscatory in many ways because it's going to need to be.
But it won't necessarily be destructive and higher taxes on income. It'll be assets, right? Because millennials focus on income and they don't have any assets. You know, all things being
I agree.
Equal. Sorry to jump in there, but
no, and you're right to. But until we see what the state of play is when this happens, you know, maybe we get, or maybe the inflation problem becomes too much and they are forced to jack rates up to 8, 9, 10%. It's happened before. It will happen again. It will happen again at some point. And
Oh
we
man, the,
see
the
a natural.
Vancouver real estate market
Can you
will get
imagine?
crushed. Oh my
Right, right,
God,
right.
Steve.
So maybe
Yeah,
you
keep it
don't.
down over there, eh?
But you may not have to tax people rich. The market may do its thing, right? I mean, you may see house prices halve. And look, let's face it, if the average house price in Canada or Australia halved, it will be back to where it was probably no more than 3-4 years ago at the most, right? I mean, that's the
True.
reality of it. So in absolute terms, what we're talking about here in terms of getting houses back to affordable levels, they probably have to fall 70%, maybe 75% for them to become affordable for people to get a mortgage on 3 or 4 times salary, which is what the standard metric used to be. And now it's in the teens, in the 20s in some of these places.
Let's
Well,
just
that's
stick
what.
with let's
Well,
you're
on
done,
Grant,
Rich. That's
Grant,
enough for Rich.
do you do you see a scenario where, yeah, I mean, you talk about inflation that needs to continue to run high, just given all the debt problems that we have. Central banks basically need it. Do you see a scenario where, home prices, whether that be in Canada, Australia, New Zealand, UK, whatever, they just rise in nominal terms, but on a real adjusted basis, they go nowhere or decline for a decade or more?
Yeah, look, that could happen. And that would, I guess, be the most peaceful way around it. But for that to happen, to Rich's point, we need wages to go up. We're going to need wages to go up because nominally, if the house prices keep going up, people still need to pay for them in nominal dollars. And so it becomes a problem unless interest rates go up and people can pay for them with the return of their savings finally. But hey, guess what happens if interest rates go up? It's an intractable problem, whichever way you look at it, right? Where we are, there's the world as you wish it to be, and there's the world as it is. And we've had this kind of sweet spot where the world as everybody wished it to be was the world the way that it was, right? Interest rates were low. Asset prices were going up. Stock markets were stable. Bond market was stable. Everybody who was involved in that, which is way too small a section of society, but it's big enough for it to matter. The world as they wished it to be was exactly the same as the world as it was. And so everything was good. Now, however, the world as we wish it to be, and more importantly, I think, to my earlier point, the world as we've become accustomed to it being, no longer works as effortlessly as it has done. So now they're battling every way they can to keep the world as we wish it to be and the world as it is aligned. And that's going to get increasingly difficult. And so once the world is not as you wish it to be anymore, and you have to deal with the world the way it is. If you're young trying to get on the housing ladder, you know that problem. If you're wealthy in asset terms and you have a government who is going to start putting big taxes on that, well, suddenly you know what it's like to live in the world. And so we're reaching a day of financial reckoning, and that is going to be a day of societal reckoning. And it may not come for a year or two. I mean, who knows, right? We just don't know what is going to tip this thing over. What we do know is that the status quo is unsustainable, completely unsustainable. So what's Stein's law? If something can't go on forever, it'll stop. And this can't go on forever. So it will stop. And so a lot of people have exited and they're just on the sidelines now. They've taken money off the table and they're waiting for the pullback. We've seen this in places like Germany. We've seen bank lending to real estate in Germany dry up completely. Literally, German banks say, we will lend you zero, and we'll give you zero leverage on anything. And that's meant that there's been a housing price correction in Germany, and there's been a lot of people with cash on the sidelines who swooped in and bought those properties. But they've had to pay full price. They've had to pay 100% cash down for these houses. And that changed the dynamic. So everywhere you look around the world, everybody's followed the same policies: low rates, more debt, higher borrowings, higher asset prices. And now things are reversing. And that is going to mean lower asset prices, higher interest rates, lower borrowing, more defaults, more pressure in the real estate sector, commercial real estate particularly. We're seeing that in America every day now. So it's not the end of the world. It's part of the cycle. But the best thing people can do is realize that cycles do have bottoms to them, even though they've been convinced that that's not the case for a long time now, and prepare for it. And that just means entertaining, as I said, ideas that you haven't had to handicap too highly for many, many years now.
So Grant, just sort of continuing this, you talk about the theme and need. You know, countries have a need, central banks, individuals, households, and all that stuff. This is, you know, this is a conversation that we're having right now. They need to have this conversation. So thank you for sharing this with us. Very quickly on the need scale, from a national perspective, you don't have to explain it in detail for each country or region, but what will probably be the top three who need to act faster than others in your case? And we will hold you to it, by the way. We're going to come back.
Right. Yeah. And you want me to give you the exact dates when it's going to matter for all three?
That would be helpful. Yes.
Well, it's interesting because you can think of that question, and it's a great question, but you can think of it in a number of ways, right? You can think about when's it going to economically matter to these countries. You can think about when it's going to matter for their markets, and you think about when it's going to matter for society. And let's take Japan, for example, right? In Japan, they have an incredibly harmonious society. So Japan's problems are very unlikely to come from a breakdown in the social construct, left against right, young against old. It's just not going to happen that way. It's much more likely to be central bank driven. In America, I would say the opposite is true. I would say, particularly with this election coming up, there is much more chance that America has a societal problem before they have a central bank problem. They have a political stability problem before they have a central bank problem. In Australia and Canada, the thing that they're going to be most exposed to is going to be a recession, because of what we talked about earlier and the effects that recession is going to have on the way those societies are structured. So it's not again, it's another comparison that's just not apples to apples.
And Europe,
well, again, Europe is another political. It's not even a political stability issue. It's a political will issue, because obviously Europe needs to stay together for Europe to even be a thing that we have to worry about. And in order for it to stay together, you have to keep a whole bunch, 27 countries happy. And in an era of low rates for everybody and easy access to capital, it's really easy to keep 27 countries happy because you give them all low interest. I mean, look what happened to the pigs countries. Remember them? When they adopted the euro, interest rates went from double figures to low single digits overnight. And we saw what happened. Everyone was happy. Now, that's not the case, and rates have got to go up, and people are starting to get antsy about it. So you have to keep Europe together on a political level first for the whole thing to even be a viable question. So, everywhere you look, whichever country you want to pick, there are things that are being pulled apart. There are forces pulling at the central bank, at the government, at the public. And you have to try and figure out where those pulls are coming from and which ones are going to be the most significant. And it is different for everyone. But I think you have to worry about the US from a political stability point of view. I think you have to worry about Canada and Australia if a recession hits. So they're very, very prone to inflation and higher rates. And I think Japan, you have to be concerned. The central bank, the debt levels matter more than they've seemed to this far suddenly. And we have a currency crisis. So again, it's been a very much a kind of one investment case fits all world for a long time now. And suddenly, for everybody who's an expert on every country, because they take the same map and they overlay it from Canada to Australia to New Zealand to England, it doesn't work that way anymore. You have to now suddenly think through individual countries' situations to figure out the most likely path for them.
Grant, we want to be respectful of your time here, but as we get closer to wrapping this up, is there one thing in particular today that you look at that kind of keeps you up at night? I mean, obviously we talked about a broad range of issues, but is there one thing in particular that you've got your keen focus on?
Yeah, and I not from a market perspective, because I think with the kind of situation we've talked about, there will come a tremendous amount of opportunity for people who want to invest or speculate in these markets. There will be great bargains for investors, and there will be tremendous volatility for speculators. And for each of those groups, they're the best things they can have, right? When things go on sale, if you're an investor, it's great. If you can buy something at the right price, you don't have to worry about it. If you're a speculator and you get volatility, you're in heaven. So put put those things aside, I think whichever you are, as long as you understand what you are, and you don't think you're an investor, but you're really a speculator, you're going to have an opportunity to do what you love to do, and you're going to have entry points that will allow you to make money. What worries me much more than that is this societal conflict, is the chance of disorderly outcomes. I grew up in the UK in the 1970s, and we had strikes and riots and all kinds of toxic behavior, and the UK basically had to go begging the IMF for a loan in 1976. And that decade was horrendous. We had the IRA planting bombs all over London, heavy terrorist activity. It was a horrendous decade, and of course, characterized by very high inflation and very high interest rates. And it's not a coincidence that those things were happening at that time. And so what worries me is the fact that the potential fissures are in all kinds of directions. Everyone looks at them as left and right. Everyone's looking at right versus left, Democrat, Republican, conservative Labour, liberal Labour in America, Australia, whatever it may be. That's not necessarily the one we need to worry about. The one we need to worry about is the north-south rips, the young and old, the rich and poor, those ones, because when you go that way, it doesn't matter if you're a rich Democrat or a rich Republican, you're in the firing line. It doesn't matter if you're a young Republican or a young Democrat, you're there. So it's very difficult for policymakers to come up with policies, vertical policies, right? Certainly old, young, without getting confiscatory. And it worries me that people have gotten so used to being given things by the government, whether it be low interest rates and free money or fiscal stimulus and transfer payments, that when things start getting taken away from them, it's going to create all kinds of social disorder. And that's the thing, as a father and a grandfather, that's the thing that worries me much more now than what's going to happen to asset prices, because they will provide opportunities for sure.
Grant, it's been a fascinating conversation. Keep doing what you're doing. For those that are listening to you or listening to this conversation, want to get more, grant-williams.com. Highly encourage you to check out the podcast. Brilliant work with things that make you go as well, which is your newsletter. You're also active on Twitter. So like I said, appreciate all the work you do, and appreciate your time in the Loonie Hour. And hopefully we'll have you on for round 2 to see how this all unfolds.
Hey, I want to crawl my way out of third place, so we better make that happen.
we can do that. We can make that happen.
Wait,
Thanks,
I just have one more comment before you go.
Go ahead, Rich,
so
jump
you're saying that there's going to be some fantastic music because
yes,
the schisms of the 1970s gave us the Sex Pistols and etc. So I'm looking forward to that. Sorry, I had to throw that.
No, Rich, I love that. I love that. And it's funny because it is right. These periods are when great art happens, and so I say when I grew up in the 70s and into the 80s. The music of the 70s and 80s is still all I really listen to, more the 70s than the 80s, but that's what I listen to when I put Spotify on, or I'm always going to the 70s playlist because it was, for me, the best decade in my lifetime anyway. So yeah, you're right. That's a great observation. Bring back the boil bottom jeans.
It's great conversation with Grant. I just find him to be really interesting, big picture guy.
Yeah, it's good to have the conversation. A lot of similar themes that we've been talking about, and but I don't know if it's comforting or alarming to know that here's a person who's well respected with a really strong network in other countries and economies, and up and down the chain, and he's going into depth how we are headed for sort of an awkward moment coming up from a monetary perspective. And as we keep saying, as long as people continue to have this conversation, you don't need to be afraid of it and how it looks, but at least you are prepared, and you're not going to sound a bit awkward for everyone. What about you, Rich? What did you think from the conversation?
I thought it was brilliant. I think one of the things that I wish I had sort of jumped in was that a lot of countries had actually massively de-levered. As an example, Ireland had 100% of debt to GDP. and in the household sector, it has 25 now. You know what I mean? So there are some places where I think that there's been a lot of pain. And as a function of that, when interest rates go up, they won't suffer as much pain as he clearly outlined very eloquently. Otherwise, I agree. But yeah, I think it's a great one. The other thing I thought was really interesting is that he's right about the opportunity set. I think a lot of, as you say, Keith, it's going to be awkward. It might be painful. But that volatility, that asset reset that I think is, in my view, inevitable. I mean, I think strategists get hung up on being too bearish all the time. I think maybe that's not going to happen as soon as we think, but his idea that there is opportunity in the volatility space or the asset reset space, I think is encouraging. I think if you're talking about this, as you say, and having these discussions and you're aware of what's going on, I think you're going to be a lot less surprised when it sort of readjusts.
Yeah. And
Speaking of,
go
ahead.
So here at IceCap, this is exactly how we see it being teed up as well. And that if you're patient and you can at least have better visibility in how this is going to move, the opportunity is there. And as Grant said, you can make a lot of money coming up here, but you have to, understand and appreciate. I like to say recently, how do you make 5 times your money in the bond market? You buy the bond at 20 cents on the dollar. Yeah.
Boomer
Go
had a
ahead,
good
Steve.
joke today.
Yeah, I know it's the first time in a while, so it's pretty good.
There was speaking of deleveraging there, Rich, there was a good the Bank of Canada released their financial stability report today, and they noted what's happening with the Canadian mortgage scene. So they basically showed that Canadian mortgage holders renewing next year, assuming the Bank of Canada's projection, which is a modest decline in mortgage rates. The median increase for people renewing their mortgages will be just over 25% in their monthly mortgage payments next year. If you're renewing in 2026, you'll see about a 30% increase to your monthly mortgage payment. And that number is as high as 60% increase for those that are on those variable rate mortgages with the fixed payment structure. The ones that were ballooning out to the 70, 80, 90-year amortizations, those ones. So if you're on those ones, you didn't do anything to it. Come 2026, you could be looking at a 60% payment increase potentially.
Gee. So somebody right now, for example, say you have a $3,000 monthly mortgage. Did you just say then that for this year, for the 24-25 cycle, the mortgage payments could go up by 30%? Is that the number?
So next year, 2025, they'll see about a 25% increase in their monthly mortgage payment. That's kind of all mortgages blended in. So, take that number with a little bit of a grain of salt. And then next year, it'll go up to about 30%. Right? Because if you're renewing in 2026, you probably took a 5-year mortgage in 2021, which was kind of the bottom of rates.
So someone with that $3,000 mortgage then renewal, I mean, they could potentially be up to $4,000 a month. There's an extra $1,000 a month has to come from somewhere.
Yeah, and I still don't think it's a wave of foreclosures from a primary end user person, but I think it just cuts back on discretionary spending, which is obviously recessionary.
Yep. Yeah, absolutely.
Balance sheet recession. That's almost the almost textbook definition of what's going to happen.
And I will say this, we've talked about on the show, I still think the majority of that pain, we're seeing it now, but I think it's probably going to increase, is predominantly more so on the investor side. Yeah. It's people with 2 or 3 properties that all of a sudden, you go from cash flow neutral to now you're losing. You renewed your mortgage, right, Keith? Your mortgage went up $1,000, but you have no ability to raise your rent. All of a sudden, you're negative cash flow $1,000 a month. How long are you willing to hold on to that property? Particularly if you feel like the prospects for future price appreciation are not that great.
And what happens if you or your partner happens to lose their job during this recession that might come? Then you definitely have to sell the property.
Yeah.
We'll see. But that's our ray of light here for this week's podcast. Grab your shotgun, your gold bars, your can of beans, and head out to Rich's cabin. What is that? 2 hours south of Montreal?
just bring cans of smoked oysters. I really like those.
We got room for everybody. Bring your tent
And your Speedos.
and your Loonie Hour Speedos. I think that's a good place to end it, guys. As always, we appreciate the support, and we'll see you next week.